So let's talk a little bit about the impact that China tariffs could have on your company. You said in the conference call that a potential fourth round of tariffs could hit the company. Walk us through the worst case scenario and how the tariffs would filter through down to your bottom line.
Well, we manufacture about 30% of our jewelry merchandise in China, and so should there be a fourth tranche of tariffs, it could have an impact to our business. We're already working on that, though. The good news is that our vendor base is highly multinational. Many of them have manufacturing facilities in a number of different countries, and so we've already spent time working with them on how we could mitigate the tariffs. Unfortunately, I think then some of them might need to flow through in pricing to customers, but that would certainly be a last choice for us. Customers trust and expect good value jewelry merchandise from us, and that would be our aim, is to make sure we can continue to provide that.
I see. So perhaps not so much elasticity when it comes to raising the price point. You didn't put or factor in the Chinese tariffs into your guidance. What is your base case, therefore, at the moment? That these will be avoided? Do you generally stay optimistic that this won't come into play?
Well, we factored the first three tranches of tariffs into our guidance. They don't really have a material impact, but they're known, and so we're able to factor it in. We didn't see that it would be prudent to factor in the fourth tranche since it isn't yet defined. We remain hopeful that some negotiated settlement can happen and that we will be able to mitigate as much impact as we possibly can.
You've also indicated that you have no presence, or no exposure, I should say, in Mexico. So the discussion of tariffs in Mexico on Mexican imports doesn't impact you quite as much. But talk a little bit about Brexit, because for you guys, that actually could have a direct impact.
Well, you're right about Mexico, so that will not have an impact. We continue to see a challenging macroeconomic environment in the UK. Customer sentiment has been weak, and I think definitely impacted by Brexit. And so we're expecting that we continue to see headwinds in our UK business.
H. Samuel and Jones, companies I know well from being brought up in the United Kingdom. How do you differentiate these sorts of brands? It's interesting that we've had some opinion pieces, right, that to a certain extent here in the US, Kay and Zales are basically the same store but under a different name. How do you ensure that the right buyer is in the right store at the right time and being given a differentiated product?
Well, we've been working as part of our Path to Brilliance transformation to differentiate all of our store banners, both H. Samuel and Ernest Jones in the UK, as well as Kay, Zales, and Jared, even Piercing Pagoda here in the U.S. market. We've been doing that in a couple of different ways, most importantly through our merchandise. So we've really studied which customers are buying and which of our banners and how we can offer differentiated merchandise to those customers. Secondly, in terms of store experience, we work with our sales consultants on the type of customers that are coming in and helping everyone from people looking for a bridal engagement ring to, in our Ernest Jones stores, often looking for a luxury watch brand or looking for a bridal purchase. So we've really been working to differentiate those.
And we're seeing plenty of pictures of the sales force at work. People come into a store when they're making a big purchase, such as an engagement ring, but e-commerce has got to be a huge driver of growth for you. How, as you look to close stores, as has been your cost-saving focus, are you looking to more depend upon the e-commerce area and continue to drive growth there?
Yes, absolutely. We've put a big focus on driving growth in e-commerce over the last year and a half. We announced in the quarter that we're up now to almost 11% of our sales, which is a significant growth. We had double-digit growth in e-commerce in our North America market. That's really a result of our offering of products that we have in store. We have quite a large selection, and so if someone comes into our store and they can't find what they're looking for, our store associates can go online and find the huge offering that we have there and meet their needs. We also have added some very innovative tools to our online websites. We've added configurators so that customers can come and create their own jewelry. We had virtually a doubling of sales from that kind of a tool from last year to this first quarter.
Gina, another question for you here, because we spoke about a year ago and we talked about the corporate culture there at Signet. And I know you're working to repair the corporate culture in the wake of the gender discrimination case and sexual harassment charges. There is a lot of arbitration and non-disclosure that prevents former workers from being able to tell their story, testify what happened, share their experience. Are these arbitration agreements still compulsory? Are they still part of the culture?
Well, we've made changes, I think, across the board in our culture. Certainly, I can't talk about active litigation, but since I've been in place, we've made significant progress in terms of gender representation from our board of directors, which is gender parity, one of the few public companies, as you would know, our C-suite, and all the way down through our management ranks. More than 70% of our employees and our store managers are women. And we do not, at this point in time, have compulsory arbitration in place. That's something that we've moved on from.